All right, so today I wanted to make a video on a stock I've briefly talked about, but I haven't dug deep into it. That is MSCI. Now again, I started buying here when it had a dip very recently. It dipped down to around 450 roughly. Actually, it's about 442, give or take. And again, that is basically the 52. That is the 52-week low for this company. So I started buying there. I've been buying ever since, and frankly, I think that this company is probably about fair value where it's at right now. I think I would, if anything, I'd probably argue a little bit undervalued. And I mean, I'll get into my price targets later. So again, $40 billion company. The free cash flow yield, the earnings yield about 2.8, 2.9%. That's a little bit lower than I would prefer, but again, still okay. And again, if you look at analysts, their price target is 558 is the average. And that's probably about 540, 550. That's right where I would stop buying it. So at 505 right now, I think if anything, we're probably a little bit undervalued. So again, they are basically a indice. Again, MSCI engages in the provision of investment decision support tools, including indices, portfolio risk, and performance analytics, and corporate governance and services. So again, they're an index maker, right? When it comes to bonds, stocks, you name it. So let's get right into it here. If we start with the insights, again, profitability. This is where this company really shines. Gross margin 82%, operating margin 53%, net margin 44%. Like these are like borderline Visa, MasterCard numbers, which are phenomenally impressive. Management again is doing okay. Return on invested capital, return on equity are both very strong, 35%. That's very, very good. Financial health is okay. I wouldn't say it's bad, even though it is kind of ranked bad here. That's mainly because of the intangibles and the book value. But again, they are buying back a significant amount of shares. Current ratio of 1, that's probably about average, maybe a tiny bit below average. The growth is also pretty solid. Every metric is growing nicely there. Dividend I'll get into later. They're projected to grow earnings 6% next year, revenue 12%. Those numbers probably should be a little bit better, but I think over the long run, they're still going to be okay. And again, they are below all of their historical averages, but those are all pretty expensive. And again, some people probably would argue they're still expensive where they're at right now, which again I'll get into. Financials again here, the bread and butter. This is the most important stuff here. So first things first, if we look at the revenue here, it is a consistent staircase higher. Almost every single year, every single year going back to 2012, the numbers have gone up every single year. They've almost tripled their revenue over the last decade, which is very good. Gross profit, it looks like they have tripled. If we look at net income, again, that's gone from 222 million to 1.15 billion. So that's what, like 5x. Earnings per share, again, it's gone from $1.83 to $14.39. That's very good. The shares outstanding, this is one of the areas where they really, really shine. Again, going back to 2014, the year ending 2014, 117 million shares outstanding. The year ending 2023, about 80 million. So again, that's what, like 3.5% per year, which is phenomenal, right? That's exactly what you want to see. If we look at the metrics again here, this is one of the many areas that it shines. Look at the free cash flow margin here, just consistently good. I mean, going back a decade, even going back like 15 years, the lowest it's ever been is 25%, which in and of itself is very impressive, let alone the average being probably 40%, which is extremely good. Operating margin 54%, that's just crazy good, right? Crazy good numbers there. Like the return on invested capital, which is also phenomenal. And I mean, not to mention too, when you go back to 2020, and 2021 and even 2022, a lot of these companies during those down years, I guess there was an up year in between there, a lot of companies got hit really hard, but they didn't. I mean, they didn't get hit hard at all. So I wouldn't necessarily call it a recession-proof company, but at least to some degree, I think you could make that argument. This is pretty much the bread and butter number you want to pay attention to when it comes to most stocks is free cash flow per share, because at the end of the day, free cash flow is the bread and butter. That is the number you really want. Going back to 2013, sorry, 229 a share. Now they're up to 14.34. So they've almost 7x'd their free cash flow, which is just absolutely crazy, right? So I really like that as well. The other thing here to get into, the dividend. Over the 5 year, they're up 22% per year. The 3 year, they're actually growing it faster. And I mean, if you would have bought this company a decade ago, you would have a 14% yield on cost, which is absolutely crazy good. And the payout ratio being about 43%, that's a little bit higher. Are they going to be able to grow at 22% per year over the next 5 to 10 years? Possibly. I would say that number probably comes down a little bit, but I still think they can grow 15, 20% per year if they can maintain anywhere close to the amount of growth that they've had. And again, this is another example of a company that the kind of dividend stock that I really like, in that the dividend's only 1.27%, but they're growing it 22% per year, right? You're better off to have a company that does that over 10 or 20 years than a company that has a 7, 8%, 9% dividend right now that isn't growing. So again, just another example of a very good metric. So again, if we look at the growth numbers here, let's try and project fair value and all that kind of stuff. So when you look at the historical price to free cash flow going back 10 years, the average is 37.5. They're currently at 37.1. So almost exactly on that number. The average PE 41 versus 30, just under 35. The average price to operating cash flow, again, is almost exactly right on as well. So again, based on historical numbers, I mean, if anything, they're maybe a tiny bit undervalued here. The problem with that is 37 price to free cash flow that's a little expensive, right? That's a little expensive. So again, if we look at the growth numbers here, again, they've grown free cash flow per share 23% over the last decade. If you go back about 5 years, about 19%. If you go back about 3 years, you're looking at about 17%. So based on those numbers, right? Based on those numbers, let's see what the valuation should be, right? So if you project 10% free cash flow growth per year, buy back 2% of shares, grow the dividend 15%, and a 25 price to free cash flow, which I don't think any of those numbers are aggressive at all, you get a fair value of 505, which means you're going to grow at 10% per year. So like I said, I would still be, I mean, let's just say you project 13% free cash flow growth per year, which is less than what they've averaged over the 3 year, 5 year, or last 10 year period. I mean, that's a fair value of 645. If let's just say we keep it at 10, but we pay a 30 price to free cash flow, which is still less, again, fair value of 596. So I think that, like I said, I would be buying up until about 550, and even then I still think you could make an argument. The question you have to ask yourself is, I mean, once you get up into the high 30s and 40s, past that I think there's no company that's worth paying for. But you do need a significant amount of growth if you're going to pay a 35, 37, or 40 price to free cash flow. Like, you do need a company that's going to grow really quickly. But when you look at their numbers, they've consistently performed very well. Like, they've consistently performed extremely well. And I don't think that this is a business that's going to die off. I mean, you look at in 2020, in 2022, when you had the big down years, I mean, they still managed to grow very nicely in those years. I mean, the only year where they haven't grown earnings going back, whatever, a dozen years is, I mean, they've had 1 year, 2015. So, like I say, I think that this is one of those companies that's kind of a no-brainer, especially when you consider the fact that, at least to some degree, they do look recession-proof. Now, again, they are going to get hit. I mean, if we look at their share price here, let's look at, I mean, from peak to trough, their high in 2021 to their low after that, I mean, it went down 39%, which is actually, 41%. which is obviously, I think that that's more than the S&P, that's more than the NASDAQ as well. So it's not as if there's going to be no volatility, but you compare it to the S&P going back a decade, I mean, it's up 1,000%. The S&P's up just under 200. If we go back 5 years, it's still up 131 versus 94. So that's still outperforming the S&P by what, 4 or 5% per year. So I think that this is a company that clearly is going to keep outperforming the market, in my opinion. And on top of that, you're going to get that extremely good dividend growth, which is exactly what I want to see. And I don't think you necessarily have to worry about it going out of business, because does anyone really think that we are going to become less financialized in the world? Like, if anything, we're going to become more financialized. Like that is the obvious trend. So that's why I'm buying a company like this. So anyway, we'd love to hear other people's thoughts. So please like, comment, subscribe, all that good stuff, and stay tuned for more.